Hi everybody, and welcome to the Professional Forex Trading Masterclass video series with me, Anton Creel, and welcome to the Institute's offices here in sunny Singapore. It's been a couple of years since we launched the Professional Trading Masterclass video series to great success. A lot of people have completed the course, been through the examination and ended up becoming Institute traders. And a lot of people are actually in the Institute are very active in the Forex market as well. So we've had a lot of requests over the last couple of years for us to actually launch a Forex course. And people would be right in asking us to do that because many of the systematic processes that are used and have been learned in the Professional Trading Masterclass video series can actually be applied specifically to the Forex markets. So that's what we're actually going to do here. We're going to take professional trader systematic processes that are used by the vast majority of professional traders at hedge funds and investment banks and apply those systematic processes specifically to the Forex market. Now, there's a lot of noise, a lot of misinformation in the Forex markets, and probably in the Forex markets more so than any other asset class or any other market out there. And there's specific reasons why this is the case. It's because the Forex market is very heavily traded, and a lot of people with conflict of interest go out there and either push people in a direction to do the wrong thing, or they give a lot of misinformation in order for them to get paid. We're going to completely do the opposite. And the reason why we're doing that is because we are professional traders and we have no agenda behind except to teach you how to do this properly. So as we go through the course, you're going to see a lot of things that might even be new to you, which is a great thing because you're either new to Forex and you've never seen anything in the Forex market before, and this is a great place to start, or you've been around the Forex market a long time as a retail trader, and maybe you've had limited success, or even lost money, failed to make, or just lost a lot of money. You're not alone. There's a lot of people in the Forex market, in the retail Forex market, that lose money. In fact, the vast majority do lose money. There's some very specific reasons why. We'll be looking at those inside the course, but it's nothing to feel bad about because there's a lot of misinformation and conflict of interest in the retail Forex trading market, and it's very difficult to actually avoid it. Well, just by being here now, you've already started to avoid it. I can assure you that we're going to be taking the professional trader approach, and we're going to be helping you to become consistently profitable. Before we actually go into building out these large and sometimes complex systematic processes, what we're actually going to do is lay a foundation for you. And what you're hoping to achieve in the first part of this video series is to actually get yourself a really solid understanding and build a foundation in understanding the underpinnings of the Forex market. The first thing we're actually going to focus on is the definitions of currencies. What you're going to find is that there's some widespread kind of classically accepted definitions of Forex. And these definitions tend to focus on the size of the economies of the currencies that people look at. In video one, we're going to look at these classically accepted definitions, and we're actually going to compare them to what real professional traders do. So what you might find is, for example, when you go into the Forex market as a retail trader, is that everybody defines or groups currencies in certain ways. It's actually completely wrong. The way professional traders do it is they group currencies in terms of opportunity, and opportunity comes from volatility. So without further ado, let's get started let's go over to video number 1. We'll look at the definitions of currencies and start to build out this foundation. Once we've built this foundation, then you'll have a proper understanding of all the basics of the Forex market. Therefore, you'll be able to move on to the more complex systematic processes. So I'll see you on the computer screen, and I'll also see you at the end of this video for a recap. Okay, so welcome to the computer screen. The first thing we're going to do, we're going to take a look at the overall structure of the PFTM course itself. This is just to give you an idea of where we're beginning and where we're going with this. So let's maximize the presentation onto the screen. And really the PFTM, what you're going to find as we go through this is the video series is really a major lesson in macroeconomics and international trade, as much as it is a lesson in trading and portfolio management. And this is really due to the professional trader systematic processes that we're going to go through in order to obtain currency positions. And what we're going to find is that actually the professional approach is very much in the majority driven by fundamentals. So the split really is, roughly speaking, about 80% fundamental and 20% technical. And those fundamental situations that we're going to be looking at really are what we call drivers. So fundamental drivers in macroeconomics and international trade that generate for us high quality trading ideas. And then we're using technicals in the minority to overlay our fundamental analysis. And it's very much the case that if you walk onto an investment bank trading floor or walk into a hedge fund, that you'll find roughly that this split exists, that 80% of everything professional traders do in the currency markets is driven by macroeconomic fundamentals. And really anybody that tells you that this is not the case is lying and probably has a conflict of interest with your own objectives, which is to really learn how to use your own money to make consistent money over your lifetime from the currency markets. Fundamentals, macro fundamentals, drive idea generation in currency trading as much as any other asset class for professional traders, if not more so. Now, the process that we're going to go through, the systematic process, really is anchored to idea generation. That's driven by all things macro, fundamental, as we've already pointed out, but it's then followed by what we call a gatekeeping process, which consists of generating high quality watch lists, i.e. high quality trade ideas that generate high quality watch lists, and then overlaid with technical and price action indicators. The gatekeeping process is essentially what we use for timing and stopping us doing stupid things with our own capital. So idea generation in the majority, fundamentally driven, then followed by a process by which we stop ourselves doing silly things with our own capital. And the gatekeeping process consisting of watch list, technical and price action overlays. The gatekeeping process is, generally speaking, a timing mechanism. So fundamentals followed by timing. Then we have professional trader risk management and self-awareness statistics. Now, if you've ever heard of the trading strategy global macro, or heard of, for example, global macro hedge fund managers, this is what the course is going to teach you. It's going to teach you exactly this approach and exactly how to implement the approach in your retail trading accounts. Whenever you walk onto an investment bank trading floor or a hedge fund floor, the proprietary traders at investment banks and the hedge fund managers, if their remit is global macro, then this is exactly the approach that they take. So overall, the course is 80% fundamentally driven, 20% technical, and we go through several steps in order to take real positions with real money, that being macro, fundamentally driven idea generation, a gatekeeping process, a risk management process, and self-awareness. So let's start the whole process and let's lay out the real objective here. The real objective here is to provide retail Forex traders, so you guys, with a systematic approach to predicting future currency moves in the same way that professional traders and hedge fund managers do so, so you can implement exactly the same approach and make consistent money from it over your lifetime. Now, the systematic approach starts with idea generation, but there is actually a huge shortfall in understanding and knowledge in the retail trader environment versus the professional trading environment in currency markets themselves. And what we have to do first is actually plug that gap. We need to basically understand the idiosyncrasies of the currency market, so we have a fundamental understanding and foundation of what currency markets are all about. And no two asset classes are exactly the same. Currency markets have different idiosyncrasies and details to them that differ from stock markets, commodity markets, and bond markets that we just have to learn. We have to learn these things, so we have the foundation in order to build a real systematic process on top of that. Once we understand all of this stuff, we can really then move on to building a systematic process. Otherwise, if we don't have this foundation, we could find ourselves struggling with these idiosyncrasies when we build out a systematic process later on. So what we have to do is get all of this out of the way and make sure that everyone going through the video series as retail traders get this foundation and understanding of the idiosyncrasies of Forex markets. So what we have to do is get a foundation in the following areas. In video one, we're going to look at the first Forex market foundation area, and this is the opportunity set. What is the opportunity set? Well, all traders, whether it's in the currency markets, stock markets, commodity or bond markets, all traders are really slaves to volatility. And what we have to do is define what our opportunities can and can't be. So we're going to go into the currency markets and look at most of the major and minor currency pairs across the world and actually define how we look at the opportunities properly. The second thing we're going to do in video number two is look at Forex market regimes. There's different regimes across different currencies, and we have to actually define these and really understand them. This actually helps us and ties in very usefully with defining our opportunity set. So we have to understand the differences between Forex market regimes. The third thing we have to look at is Forex market infrastructure. In terms of infrastructure, what we have to understand is our parameters that we're dealing with within the Forex market itself. So who are the players in the Forex market? How do we actually deal in the Forex market? What is fundamentally driven? What is speculative? We have to understand the parameters that we're dealing with and the limitations of those parameters. And if we learn this stuff, we can learn, therefore, not to do silly things, and then operate within these parameters successfully and make consistent money over our lifetime. In video number 4, we're going to move on to some basic computational methods. So there's a lot of arithmetic generally in trading, but in the currency markets, there's specific arithmetic that we have to get a handle on. We have to understand how to do those things. So they just come to us as second nature. So when we start building out systematic processes, we can look at something and work it out very, very quickly and understand what's happening behind the numbers. So we're going to look at some basic computational methods that, once we understand, should be in your psyche for forever, and you should be able to react very quickly to very simple straight linear mathematics and work things out very quickly for the rest of your life. So then we move on to video 5 and 6, which is then moving on to more advanced computational methods. And Christopher Quill, who's the Institute's statistics analyst, is going to take you through some pretty advanced computational methods and train you on Excel in terms of looking and understanding volatility. So we'll be looking at and understanding how to look and get potential trade ideas from volatility. So we'll be looking at opportunity and risk by assessing volatility in the Forex market. And it's very important to understand that overall, what we're trying to do here as traders is always seek out volatile opportunities. And obviously opportunities bring with them some sort of risk. And as traders, we need to embrace risk, because you can't have opportunity without risk. And as a professional trader, what you need to be doing is working out the most systematic and basic processes to understand how to capture that volatility. So Chris Quill is going to take you through all of that, and things do get pretty advanced, but once you're up to speed and you understand that stuff, it's going to be great for you, because over the rest of your life, you'll be able to download data and go through these processes and be able to very, very quickly understand whether there's opportunities or risk, or both potentially, and be able to assess whether there's the ability to have positions that are going to pay you. So let's kick it all off with video number 1. And once we go through the first 6 videos, then we can actually move on, because we will have got this foundation. Then we can actually move on to building out systematic processes, which we start on idea generation, then moving on to gatekeeping, then moving on to risk management and self-awareness statistics. So the first thing we do is build this foundation. Once your foundation is strong, then we'll move on to the systematic process. So let's start with video number 1, the opportunity set. Okay, so let's get started with building out our understanding of the underpinnings of the Forex market. And let's try to establish a really solid foundation and understanding of the currency markets. So the first thing we're going to have a look at here is we're going to try to understand what the Forex markets are all about in their basics. And what you're going to find is that there's a lot of what we call noise in the Forex market, more so than probably any other asset class. What do we mean by the noise? Well, what we mean is basically the participants. So companies and people within the Forex market that have inherent conflicts of interest to your own objective, which is to make money using your own money. And these participants that perpetuate the noise, really, they divert your attention away from your objective in order to get themselves paid. And what you're going to find is a lot of brokers and educators in the Forex market, they're no different in the Forex market than any other asset class. In fact, they're probably even worse than in other asset classes. And once you start really understanding what their objectives are and how they're counterintuitive to your own objectives, you're going to begin to understand what the true underpinnings of the retail trader Forex market actually are. And you'll be able to cut through all of this noise and the BS perpetuated by these players with their inherent conflicts of interest. What do we mean by the conflict of interest? Well, what we mean is actually the people and companies that get paid on a volume basis. So they get paid a commission based on the amount of volume that trades in a particular market. So once you understand how this conflict of interest is against all of your own objectives, you're going to understand and know the difference between what is probably true and what is false in the markets. And that's going to really help you to avoid all of the retail Forex trader mistakes. And it's going to stop you losing money. So becoming part of what we call the 90-90-90 in the Forex markets, which is 90% of retail Forex traders lose 90% of their money within 90 days. And it's going to protect your downside. And the 90-90-90 phenomenon is something that we talk about a lot in the Institute. The vast majority of retail Forex traders actually lose most or all of their money in a very short space of time. And it's absolutely 100% true. You know, we have a lot of statistics in the Institute that we look at, and we've seen the 280,000 trading accounts in the Forex market, in the retail Forex market across all the retail brokerage platforms. And 90% of these accounts, plus over 90%, are actually down. They lose pretty much all of their money in a very short space of time. And once you start understanding the reasons why, this is going to help you protect your downside. One of the reasons is that there's a lot of noise. And as professional traders, what we try to do all the time is to seek out, in any market, we seek out volatility. And once we start actually looking at how the Forex market is organized, so once we start looking at how we organize the world's currency markets versus how the participants with conflict of interest actually organize the world's currency markets, we start to see that this organization and the definitions of currencies are actually different to our own. And the first thing we look at, for example, is how brokers and investment banks actually define currencies. Because what we want to do is start organizing in a professional trader way and really focus on volatility. And when we look at the way the popular media, so this is the outlet for all the noise. So we're talking about television, newspapers, and online media. When we look at the way the outlet, the media, organize and structure the definitions of currencies, we realize that they're very different to a volatility analysis. So you might think here, for example, why are we looking at investment bank definitions? Well, investment banks are really institutional brokers. They do business with hedge funds and pension funds, mainly on the secondary market side. And in the Forex markets, their clients, the hedge funds and the pension funds, trade currencies via the investment bank and pay a spread or commission. They pay the spread
on all of the currency pairs that they trade. And investment banks are simply just the institutional side of retail brokers. So essentially, they're just institutional brokers. They're market makers. They also do have proprietary trading operations. And what's actually quite surprising is that the proprietary trading operations in investment banks would take the same approach that we take, which is different to the approach that the market making side of the investment bank would take in defining currencies. And the way currencies are defined at investment banks and retail brokers, the way these guys define currencies is very much counterintuitive to a professional trader objective, which is to make money using our own money. So what you're going to find with investment banks, retail brokers, and media is that currencies will be grouped very much dependent on the size of the currency. What do we mean by the size of the currency? The amount of volume that trades per day, the most popular currencies. So the first definition you're going to see is the G10, the group of 10 currencies. And what we've got here is the classic definition of G10, which is the US dollar, euro, Japanese yen, British pound, Swiss franc, Australian dollar, New Zealand dollar, Canadian dollar, Swedish krona, and Norwegian krona. And you're going to notice here that we've got the letter C next to 4 of our currencies. So the letter C, for example, is next to Australian dollar, and the letter C actually stands for commodities. The reason why we've marked these up with a letter C next to them is because our objective is to figure out what has the most potential volatility, what has the least potential volatility, and we want to know what these currency values actually depend on. So what we've done is we've marked here the currencies within the G10. We've marked them with a C because the value of their currency is dependent, or very heavily dependent, on the price of international commodities. So just 1 or 2 particular commodities. And these differ, for example, from the US dollar, euro, yen, pound, Swiss franc, Swedish krona. They differ slightly because the other currencies don't depend solely on 1 or 2 commodities. So the prices of their currencies don't depend heavily on the price of 1 or 2 of their exports. And the bigger currencies, the US dollar, euro, Japanese yen, pound, Swiss franc, Swedish krona, these currencies that don't depend on the 1 or 2 commodities, those currencies are more diverse in their exports. And when you think about this, if a currency value is heavily dependent on 1 or 2 commodities relative to another that is very diverse in its exports, it's pretty obvious that it's more likely that the commodity currency is going to be potentially more volatile because it depends on just 1 or 2 factors rather than a multitude of factors. So we mark these up with a C to begin with. Investment banks will group all currencies together as G10. So will retail brokers. And that's basically to divert your attention away from what really matters, which is volatility. They're trying to group them all as one basket, dependent just solely on the size of the transactions that occur every day in the Forex markets. The other definition that we look at with investment banks, retail brokers, is in emerging currencies. So we're talking about countries here whose economies are small and growing at a high rate, or should be growing at a high rate, and they're defined as emerging currencies. Emerging currencies, typically within investment bank definitions, retail broker definitions, are split up into EMEA, so Europe, Middle East, and Africa, Gulf, so Gulf Cooperation Council, GCC, and also on the next page, Asia. And what you see here is that we've marked up again a bunch of these currencies with a letter C, because they're dependent very heavily on just one or two commodity prices. So the value of their currency depends very heavily on one or two commodities, because it's a very big proportion of their exports. And over here on the right hand side, we've got the GCC, and with the GCC currencies, all the Middle East currencies, you can see that they are all dependent on one or two commodities. And you can also see we've marked them up with a P. The P stands for pegged, and this is a Forex regime. We're going to look more closely at Forex regimes in video number 2. But for now, we just need to know that there's two main Forex regimes. The first one is a floating regime, where a country's currency has the ability to float freely against all other currencies in the world. And the second main regime is a fixed or pegged regime, where the value of a currency is fixed or pegged to the value of another, or to a basket of other currencies. Usually the basket is made up of the main trading partners of the country's export market. So we should know intuitively that in the Middle East, the commodity we're going to be looking at is the oil price, so oil exports of the Middle East. But we also have to be aware that all of our Middle Eastern currencies are in some way pegged to another currency or a basket of currencies of their trading partners. Again, we're doing this because we know as professional traders that it doesn't matter how big a country is, how big a currency is. It's really what matters is really the volatility of the asset itself. So when we move into Asia, we see that we have a large list again of emerging currencies in Asia, and a whole bunch of them have got dependency on commodities. And we also have a few of them, so the Chinese yuan, the Hong Kong dollar, and the Singapore dollar. These currencies are pegged regimes similar to GCC, and pegged regimes do have different nuances. We're going to look at those in more detail in video number 2. When we go into emerging currencies in Latin America, we can see that all Latin American currencies have some sort of dependency on commodities. And what we also notice is that there's no P's here next to our letter C's. So they're commodity dependent, but they're not pegged. They're actually floating. So when you go through the list here, you'll be able to see that anything that doesn't have a P is actually a floating regime, and anything that does have a P is a pegged regime. Now, as professional traders, we've mentioned or briefly skimmed over this, that as professional traders, what really matters to us is volatility. So when we define currencies, we don't really care that a country is in the G10 or not. Why would we care? As traders, what we're seeking out is volatility. So I want you to imagine, for example, a time horizon and the time horizon can be any day, any time horizon at all. So it can be 1 day, 1 week, 1 month, 3 months, 1 year. And I want you to imagine just any asset. It can be currencies, stocks, commodities, bonds. It can also be bricks. So bricks are used to build houses. Bricks have a price on the open market, and manufacturers and wholesalers, distributors, developers, they buy and sell bricks in the open markets. They buy and sell bricks with each other. Bricks have a price like any other asset, and every asset has a marketplace. And over any given time horizon, what really matters for the people trading these assets is the volatility of the assets. And if we just pick 1 day, for example, as our time horizon, and we pick a currency, so let's pick a random currency pair, for example, like the euro US dollar, and say, okay, over 1 day, we're going to buy and sell this currency, the euro dollar, over 1 day, we're going to trade it 10 times. And we're going to look at the daily volatility of euro dollar. And let's say we find that the euro dollar over a 24-hour period just doesn't move. Well, it means that when we buy and sell it, we're buying and selling it at the same price if it doesn't move. And if we're paying a broker a commission every time we trade, so a spread, and it can be a very small spread, it doesn't really matter. But if, in theory, the price is the same over a 24-hour period, and we buy and sell it 10 times and pay to do so, it means that we're not going to make any money. In fact, we're just going to lose money. However, if we do have volatility, then an opportunity and risk is created. As professional traders, that's what we care about. We don't care that something's in the G10. We don't care that it's in Latin America. What we care about is what the currency's regime is and what the currency is dependent on. And this is a driver for volatility. So instead of organizing and segmenting currencies by geography and transaction size, we organize currencies by the potential opportunity. And the way we do this in the first step, and there are further steps that we go through later in the video series, but the way we do this in the first step is to segment into 4 main categories, which are X commodity floating, X commodity pegged, commodity floating, and commodity pegged. So what we're doing is we're filtering here by currency regime and commodity exposure. So the X commodity grouping here are currencies that are not dependent on 1 or 2 commodities in their exports. And these split up into floating and pegged regimes. Then we have the commodity floating and pegged, which are countries that are split up by or filtered by their dependency on 1 or 2 commodities and then by their regime. And if you go into the download section of the video series, so under video number 1, you'll see a download button. You'll be able to download the spreadsheet, which segments everything for you. And if you download that spreadsheet, have a look through it. Just familiarize yourself with it, because it's important to start getting familiar with these definitions, because we build on these things later in the video series. And the Forex market's organized sheet, we have the breakdown in the presentation. So if you just download it, you can familiarize yourself with it in your own time. So back to this point, what's more important is that we need to start looking and understanding how we capture and segment volatility, rather than segmenting by geography and size of transactions. Floating and pegged regimes and commodity dependency is the main way we do it. And what you've got to start thinking about is how countries, the value of their currency, how a country's value of currency depends on factors outside the country itself. So the phrase we use here is exogenous factors. So exogenous factors are factors that affect the value of a currency, but they are outside the control of central authorities within the country. So for example, if you're a country that depends very heavily on one trading partner on the other side of the world, but that trading partner has a difficult time in their economy, that is going to have an effect on your currency as a country, whether you like it or not. It's an exogenous or exogenous factor that is affecting the value of your currency. It's out of your control. Now, these are very important to professional traders because this is one of the drivers of volatility. And that's why we segment by commodity and by regime. Now, we've put the results here of our breakdown from the Forex markets organized sheet. And the first thing we look at is the ex-commodity floating currencies. And what we find is we break down, first of all, by developed float. So what do we mean by that? We mean developed economies that have floating regimes that are not dependent on commodities. Then we have the EMEA floating currencies that are ex-commodity, the Asia Pacific floating that are ex-commodity, and the LATAM. And you can see there's no Latin America there. The next definition is the ex-commodity pegged regimes. So we have Denmark in here. Denmark's not in the G10, but it's a developed nation and is an important trading partner of many European nations. So we've included it in the analysis. So developed ex-commodity pegged, the Danish kroner, which is pegged to the euro. We also have Asia ex-commodity pegged, and we have in Asia the Hong Kong dollar, which is pegged to the US dollar, and the Sing dollar, which is pegged to a basket of currencies that are not made public in terms of the weightings and the exact sizes of those weightings relative to their trading partners. In the Forex markets, commodity floating, so we're talking about floating regimes that have commodity exposure. We have our four that we looked at earlier that are part of the G10, but we don't call them G10, we call them developed commodity float. We have our EMEA commodity float, our Asia commodity float, and Latin America commodity float. So all of these are floating regimes that have significant exposure in their exports to one or two commodities. And then the next part of our opportunity set, the commodity pegged, we break down as EMEA and Asia. So EMEA commodity pegged and Asia commodity pegged. And we have here in EMEA all of the GCC countries, and the only Asian currency that has significant exposure to commodities and is pegged is the Chinese yuan. And we have the question mark here next to the Chinese yuan, similar to the question mark next to the Sing dollar. Why is that? Well, it's because the way in which the currency is pegged is not fully 100% aware or understandable. So for example, with the Singapore dollar, there is a basket of currencies that the Singapore dollar is weighted towards. We don't 100% know what those currencies are, and we don't 100% know what the weightings are. And that is essentially to stop speculation on the currency. The Chinese yuan is pegged against the US dollar, but it's what we call a crawling peg, in which it's not exactly fixed at a particular rate. The rate changes, so it's questionable. Again, we'll look into these things properly in video number 2, but for now, we just need to get this principle down, which is we have to start segmenting and defining currencies based on their opportunities and risk, i.e. their volatility. And by doing so, we create our opportunity set. The opportunity set is essentially working out where the opportunities lie to make money as traders. So we've got 46 currencies in total. 36 of them are floating, and 10 of them are pegged or fixed regimes. So this potentially limits our opportunities to 36 currencies in the market, because the pegged or fixed regimes mean that the currency value is controlled by the central authorities within very tight specific ranges. What do we mean by that? Well, the central authorities themselves intervene in the currency markets, and they make sure that their currencies stay at a certain value. Now, as we talked about earlier, with asset prices staying at the same price, we use the euro dollar example. If an asset price stays at the same price constantly over any time horizon, so 1 day, 1 week, 1 month, 3 months, 1 year, and we buy and sell that asset at the same price all the time and pay to do so, we simply can't make money because there is no volatility. This is the same situation with pegged or fixed regimes, because they stay at the same price every day, every week, every month, every 3 months, every year. Therefore, we know as traders there's no volatility and no opportunity to make money, unless, of course, the central authorities decide not to continue intervening in the currency market. But as traders, we're not going to, for example, sit here for 5, 10, 20 years and just watch a currency every day trade at the same price, waiting for something to happen. We need to just segment by volatility and opportunities and focus on where the opportunities are on a consistent basis. So what we find is that out of these 36 potential opportunities, 17 of these opportunities are floating currencies that are ex-commodity floating. So they're non-commodity currencies, meaning the countries don't have significant exposure in their exports to one or a multitude of global commodity prices. 19 of the floating currencies, 19 of these opportunities, are what we term as commodity currencies. So the countries have got significant exposure in their exports to one or two commodities. What we also find is that 4 of the currencies have significant commodities exposure. So the ones that do have that exposure are G10 currencies. So G10 as defined by investment banks and retail brokers. So they're developed. They're quite large economies. All LATAM currencies, Latin America currencies, they're floating, and there's the Latin American countries. There's no Latin American countries that don't have significant exposure to commodities. The only EMEA countries that have pegged or fixed regimes are GCC countries. And we also find that Denmark is the only developed economy with a pegged or fixed regime. And the DKK, the Danish kroner, is pegged to the euro. What else do we notice about our opportunities when we segment in this way? Well, we find that the Hong Kong dollar and the Singapore dollar are the only Asian currencies without significant commodities exposure. So they're pretty diverse. The only ones that without significant commodities exposure that actually have a pegged or fixed regime. The Chinese yuan is the only commodity exposed currency that has a pegged or fixed regime outside the GCC, and that's pegged to the US dollar. And the Sing dollar and the Kuwaiti dinar are the only pegged or fixed regime currencies that don't disclose the weightings of the currencies they are pegged or fixed to. So here we've got our 36 currencies, our 36 potential opportunities, and we've put them all on the same page here, so it's easy for you to view. Here we've got Forex markets floating. Well, that's actually non-commodity floating. So what we've defined as floating regimes that don't have significant exposure to commodities. And then we have Forex markets commodity floating. So these are our 36 opportunities. And these are the ones that we're going to basically have to not consider as volatile opportunities. So we have here the X commodity pegged, which includes the Danish kroner, the Hong Kong dollar, and the Sing dollar, and the commodity pegged currencies. So these are the ones that are not going to move. There's no volatility, or volatility is extremely small. Another way in which participants, so conflict of interest participants in the Forex markets, segment currencies, is you will find brokers, investment banks, media outlets, so television, newspapers, online media. Everything tends to get quoted against the big currencies, and the generic one is against the US dollar, because the US dollar is the world's reserve currency. So what you're going to find a lot of the time is everything is quoted against the US dollar, or it's quoted repeatedly against the US dollar, so, or by default. So the currency cross or pair that's generically quoted against the US dollar is called a dollar cross. And that can be any currency in the world. So let's have a look at one now. The Russian ruble, for example. At the time of writing, the Russian ruble was 62.35 to the US dollar. And the way you read that is one US dollar equals 62.35 Russian rubles. So $1 buys 62.35 rubles, or it takes 62.35 rubles to buy one US dollar. The dollar majors are termed majors because it's all the major currencies quoted against the US dollar. And these make up 85% of daily transaction volume in the Forex markets globally. And when you look at the major currencies, so we look at Euro, Yen, Sterling, Swissy, Canadian, Aussie dollar, Hong Kong dollar. When you look at the major currencies against the US dollar, these are the ones that make up the vast majority of daily transactions. And what you're going to see is a table quoted on all media outlets. So whether it's on television, on financial news channels, where you have the ticker dropping across the bottom of the screen, or whether it's online, or whether it's in the newspaper, you're going to see a table of cross rates, so currencies that are quoted against the US dollar. So we call these the dollar majors. And we're again falling into the trap here as retail traders. Again, we're falling into this trap of segmenting currencies by the size of the economy or the size of the transactions that occur. And we have to be very careful, because what really matters, obviously, is, as we've pointed out, the volatility of these currencies. So you can see, for example, in the table here, this is every currency that's quoted against the US dollar. These are known as the dollar majors. Cross rates, specifically cross rates, are defined as the currencies that are not quoted, the cross rates that are not quoted against the US dollar. Cross rates are quoted as the majors against each other. So, for example, we have here the Canadian dollar quoted against the rest of the major currencies. So the Canadian dollar here buys 95.859 Japanese yen. And this is the table, when you combine the whole lot, this is the table that you're going to see all the time in general media outlets, the dollar majors and the cross rates. But we know better now. We know that when we see this, this doesn't mean what we're looking at is a table of opportunity. The table that we're looking at is just major currencies against the US dollar and against themselves. And that doesn't necessarily equal volatility, opportunity, and risk. So we segment in a different way. As professional traders, we have to segment based on what the currency is dependent on and what regime the currency is part of. That's the first step we take. So we're going to build this out further as we go through the video series, but we've taken a very important first step in defining exactly how professional traders group their currencies, and those groupings are based on the principle of seeking out volatility, so opportunity and risk. So we've taken that first step. We'll build out further, and what we have to do next is go to video number 2, and video number 2 will be concentrating on really understanding the differences between Forex regimes, so the fixed versus the floating regime. Before we move on to video 2 though, I'm going to go, let's go over to the trading desk for a quick summary, and then we'll shoot over to video number 2 and continue to build out this foundation.
Okay, so welcome back to the desk. What you just saw there was the first real step to understanding and getting a foundation in the global currency markets, which is actually to look at the opportunities, the opportunity set that the global currency markets present to us as traders. And that first step is really understanding definitions. When you see, for example, as a retail trader, a daily rundown sent to you by a brokerage company or a media company, like on television or in a newspaper or even online, what you'll find is that all of these people, all of these companies, they group currencies based on these popularized and predetermined definitions. And what you saw on the computer screen was an example of how they all do this. So grouping all of the dollar crosses into one area, grouping all of the non-dollar crosses, so the euro crosses, the yen crosses, the sterling crosses, all into one area. And it's all really predetermined by the size and geography of the countries and currencies themselves. So big countries are put over here. So big countries against the US dollar, big countries against each other. And as a retail trader, you get hammered all the time with these definitions. And it's actually the wrong way to look at things, as we discovered. And the way professional traders look at things is they actually start splitting up things immediately into definitions which perpetuate a definition that is anchored to volatility. And the first step we took there was to look at the different regimes and look at what the currencies are actually connected to. So we're not really caring about the size of the economy at the moment. We're not really caring about the geography. What we're caring about is what regime is the currency, and is there an opportunity there? So fixed or floating, and are they connected in any way to a commodity or maybe two commodities? And we do that because volatility is subjective to the concentration of being exposed to one or two or a multitude of factors. So what we did was we split up the 46 currencies that we have available there in that opportunity set and split them up in a way that defined them by potential volatility. Now that's just the first step. We're going to move on as we progress through foundation into defining these currencies further on a volatility basis, not on a size of the economy or geography basis. It's very key to understand that everything we do as professional traders needs to be focused on capturing volatility. So we will build this out further, but for the moment, just take the basic principle as professional traders have to capture the volatility. So we've taken the first step. So we've defined the opportunity set and defined the definition. The next thing we're going to do in video 2 is really understand the difference between fixed and floating regimes. You need to understand the history of Forex and get a really strong foundation of the differences between fixed and floating regimes. So I'm going to see you back at the desk in video number 2, and we'll look at those differences in great detail.